Good morning, good afternoon, good evening. Depending on where you're joining us from, we would like to welcome you to today's webinar. My name is Winfred Amwako, and I'm the Growth Marketing Lead here at Akiva. We are super excited to have you join us today. But before we get into the weeds of today's discussion, I would like to quickly just do some housekeeping, just so that we could all be on the same page. So if you look at your screen, you would find a tiny arrow pointing to the left or to the right, which will be your control panel. This is how you can communicate with us during the webinar discussion. So we have muted you so that we wouldn't have too much interference during that discussion. But then you are able to just input your questions in the GoToWebinar chat feature window. So please feel free to send us questions anytime at all that you would like to clarify something from us. So today's discussion topic is going to be about the connection between finance and supply chain performance to a firm's financial success. In the previous weeks, we have discussed the topic of supply chain digital transformation, where we have looked at the steps and best practices on how to carry out a supply chain transformation. We also discussed the topic on how to build a business case for your supply chain S&OP transformation. And then we touched on the practical guide to improving your S&OP planning. And to bring it into full circle, today's discussion is all going to center on the connection between finance teams and supply chain teams. So most often than not, these two teams are siloed or very different departments, and they don't necessarily talk together to each other. But then they are very dependent on each other, because supply chain teams help to drive the financial success of the company, and finance also need to know what supply chain is doing in order to plan for the future, as well as be on the same page. Next slide, please. So I would like to quickly just give you a quick overview of who we are. So our name is Akiva. We've been around since 1993, 28 years already. Wow, which is a long time. So we've been in this space of supply chain for a long time, and we have really gone through various transitions to become a real big leader in supply chain space. So we started supply chain. So let me give you a quick overview, a quick history of Akiva, just for the sake of all the new folks on the call today. So we've been around since 1993, as I already said. We started with the first generation planning solution, which was more of a demand planning solution that primarily was built to integrate with other supply chain planning systems. And then we built the second generation system, which is ZMeter. And then we rebranded and became Akiva. So we have really gone through a robust kind of transition to become who we are today. And in this year's Gartner MQ, we were one of the top 3 within the visionary position. So we are really strong contenders in this space. And even Gartner sees us as really good partners for digital transformation. And so we are really well versed in terms of supply chain. So one fun fact about Akiva is that we live and breathe supply chain. It's all about supply chain in the office all the time. All we talk about is how can we make our customers really excited to want to work with us? How can we make our customers really successful in this day and age of so much chaos, so much uncertainties around the world? And so we have over 17,000 users across the globe worldwide who work in various industries. They work in chemical to food and beverage industries, as well as consumer packaged goods. So we have a really wide verse net of users within our ecosphere. And within our ecosphere, we have people planning revenue solutions of over $70 billion in total revenue. And we also industry agnostic, which means that we can fit into many different industries as well. We are a global company and we have offices in North America, Europe, and Asia Pacific. Next slide, please. And so to give you a quick overview of what our solution is all about, our full suite One Plan S&OP solution has so many different components within our supply chain. So we start from integrated financial planning, which is going to be heavily centered on what we are discussing today. So to real-time demand planning, and then optimize inventory management, as well as demand and supply synergy and continuous capacity planning, and also dynamic S&OP monitoring and visualization and execution. So let's move on to the next slide, please. So today's topic is going to be on the topic of linking supply to performance to financial performance, and I would like to pull in our expert here, our in-house expert Tepan, to introduce himself as well as carry on with the rest of the slides. Carry on, please.
Hello, good morning, everyone. This is Tepan Malik. I am with the Solution Advisor with Arqiva, and I am going to be talking today on linking supply chain performance to financial performance and how to speak the language of finance. I hope you enjoy the topic. So let's see. So here is the agenda for today. So first, I will start with an old study that was done by the Stanford University and INSEAD of France. They actually did some study that talks about how the supply chain impacts the financial performance. Then I will present another study where it shows that if you have a supply chain glitch, then how it impacts your stock performance. So basically, like the point that we will try to make is that the supply chain does have some impact on the financial performance of a company. Then I will go into the lessons learned, and then we'll look into some financial metrics that is watched by investors and Wall Street. Then I will review some financial terms that the supply chain manager should be familiar with. And then we'll be talking about the SCM drivers that drive some of the financial parameters. So once we have this understanding, then I will present with a case study where we have applied this concept. So let's look at the Stanford INSEAD survey first. So the study is pretty comprehensive. Actually, it did a statistical analysis of 636 companies from global 3,000 companies in 24 industries. It interviewed more than 75 executives from 60 companies, and there were 100 responses to a web-based survey to capture supply chain insights and experience of leading executives across North America. So this is a fairly comprehensive study, and what they found is that they did find a strong statistical correlation between superior supply chain performance and financial success. They also found that the supply chain is a critical driver of shareholder value and competitive differentiator. And also another thing that they found is that the leading companies have paid quite a bit of attention to designing the integrated operating models. They emphasize the internal and external integration, like removing the internal silos and integrating with the customer, which is quite well recommended by the different EPICS material. Also, they simplified their business process, and they were constantly adapting the process to the changing market needs. So it's not just the supply chain transformation, but also the operating model integration, process integration, silo, removal of silo, and process simplification. These are all contributes to financial performance. So they also made another study where they tried to find out like how the market capitalization changes by different performance categories. So they defined like 4 types of performance. So like the leaders, for example, who have been through supply chain transformation, and they are going through the continuous improvement to stay in that leaders category. Excuse me. So that is one category. Then there is a laggard category where the companies who have not done any supply chain transformation nor are making any attempts to doing so. So they are kind of like a laggards category. Then there are companies who are in the process of doing their supply chain transformation, and they are called transformers. And decliners are those that have done supply chain transformation, but due to lack of continuous improvement, their performance is declining, and so they are called decliners. So what they found is that the leaders show market capitalization growth between 7 and 26% above the industry average rate. Transformers showed an average boost in relative market capitalization of 8%. And the laggards actually trailed the industry average by 2 to 5%. And the decliners have shown an average drop in relative market capitalization of 25%. So that's a fairly good study. And so the conclusion from this study, we can say that the transforming supply chain operations can have substantial impact on growth in market capitalization. And they also found that the improvement-driven companies not only caught up, but also outpaced the traditional leaders that did not continually improve their capabilities. And finally, so this things actually, we can safely conclude that the supply chain initiative can impact financial performance. So here I will share with you what does the supply chain glitch, how does supply chain glitch actually impact the stock performance. So here is what happens. I mean, before the announcement of glitch, I mean, the market might get signal from like the dissatisfied customer, suppliers who are failing, rising inventory level, the industry trend, or the analyst reports. So market already sort of starts getting some sense of if things are going wrong, the news kind of floats around. That does have some impact on the stock performance. And so what we found is that the overall, I mean, if there is a glitch in the supply chain, then overall loss of shareholder value is roughly around 18 to 19%, of which you lose about 7.5 to 8% you lose on the day of the announcement, and about 9% you lose prior to announcement, and about 2% post announcement. So which they show it in graphical form. So here is the prior to announcement, there is about 9% loss in the shareholder value, and then on the day of the announcement, about 7 to 8%, and then the 2%. So that's the so essentially the point that we are trying to make here is that the glitch actually does impact the performance. So we really need to somehow learn how to link the supply chain performance to financial performance. So we need to develop some understanding. So most businesses measure success through a high-level set of financial metrics like the operating income or net income, increasing or decreasing, return on investment, earnings per share increasing or decreasing. And the supply chain managers need to link the results of supply chain decisions to financial performance. And by showing linkages between supply chain work and the financial outcome, we can the supply chain function can gain visibility with the senior management. So here is the some of the benefits from supply chain improvements that sort of shows up in the income statement in the financial performance of the company. So like the revenue growth, for example, which results from the supply chain activity of improved customer service or improved forecast accuracy, improved profitability due to increase in revenue, increase in customer service, and lowering of the variable and fixed cost, improved asset utilization through improved supply chain planning, shorter cash to cash cycle time through reduction in the inventory days supply, improving the cash flow, or improving the net asset. So these are all things that happens because of the supply chain management improvement. Now, here is an example of like, I mean, if you just say, for example, we talked about the cash flow in the previous slide, but let's say you ignore the cash flow, it does impact your ability to fund operations because of the excess inventories, overdue receivables, poor invoicing or credit practices, failure to write off obsolete inventories or uncollectible receivables, or poor investment decisions. So these are all things that can contribute to your poor cash flow that might impact your ability to fund your operation. So what do we need to do? So we need to somehow learn how to communicate with the C-level executives whose lingua franca is really sales growth, EPS growth, operating margin, capital utilization, cash to cash cycle time. That's the language they understand, they talk about. Whereas the supply chain managers are primarily focused on one financial parameters, which is the operating cost. So we need to learn how to speak the language of finance to get the attention of senior management. So lessons learned is really that the cost reduction is important from the supply chain manager's perspective, but we also need to understand like how the supply chain initiative reduce the probability of future glitches and how it improves the financial performance. So the financial metrics watched by investors and Wall Street, we need to understand that. So here are primarily like four or five things that the security analysts or the Wall Street analysts look at: the valuation ratios, profitability, which includes gross margin, operating margin, net profit margin, the financial strength, like how much debt you have, management effectiveness, like how much dollar you are, what is the performance based on your investment, based on your asset, what is the return on your equity. So those are the three primary metrics that the security analysts look at. They also look at the earnings per share. Is it growing per quarter, quarterly, or year-over-year basis? So these are the things that the security analysts look at. So here is some quotations that I have collected to share with you. Like for example, a growing operating margin, decreasing expense, obviously security analysts look at. They also look at income statement. I mean, are the sales and earnings growing consistently? That's something that they look at. An upward trend suggests that the management has been planning well. Another parameter of management excellence is the return on equity, which is a measure of profitability of a corporation in relation to stockholders' equity. Another thing that the security analysts look at is the shareholder value, which is influenced by the increase in the income and cash generated by the business. So increase in sales, earnings, and free cash flow sort of improves the shareholder value. So these are some of the key criteria, key metrics that the security analysts look at. So in this section, we will review some financial terms that the supply chain manager should be familiar with. So for example, some rudimentary familiarity with these basic three statements will be very helpful. One of them is the income statements, which is like a report of earnings over a specific period minus the expenses. Balance sheet is a report of what the firm owns, which is the assets, to what the firm owes to the debtors or the shareholders. And the statement of cash flow is kind of like a bank account. I mean, it's a report detailing the source and use of cash from the operational, investment, and financial perspective. So those are the three key financial statements. And here are the key components that are of interest from these three financial statements. In the balance sheet, obviously, as we said, the assets and liabilities. So under assets, you have cash, the accounts receivable from your customer, the inventory that you hold, the fixed assets. And in the liabilities section, you have accounts payable that you owe to your vendors, the shareholders' equity, the retained earnings. These are all sort of components of interest from the balance sheet. In the income statements, you have the the components of the income statements is the net sales. You subtract COGS from that, then that generates the gross income. From that gross income, you subtract the selling, general, and administrative expense. You subtract operating expense, then you get the operating income, and then you subtract other expenses, then you get the net income. In the cash flow statements, it shows you the cash from operating activities, and also if there are any capital expenditures that you want to fund, I mean, that also is part of the cash flow statement. So here are some basic, very simple examples of the income statement. Obviously, as we defined the income statement as sales minus expenses, I mean, it could be profit or loss depending on how well the business is managed. The sales is the amount invoiced to customers for goods and services, less returns, allowances, rebates, and discounts. And the expenses are the cost of sales. And then also it could be segregated into variable cost and fixed cost. And then the income statement kind of shows you different percentages, like for example, the gross margin, the operating margin, the net margin. These are all part of the income statement. So here is a very high level, very simple income statement. So sales and transfer, for example, is the $1,200 million. And you subtract from this the variable COGS and all other variable cost. So that gives you the variable contribution of $658 million. You subtract from the distribution expense, the fixed COGS, the selling, general, and administrative expense, the R&D expense, management and admin, other costs, and other costs. So total fixed cost is about $528 million, which you subtract from 658. It gives you the pre-tax operating income of 130 million, and then you subtract the tax from it. So the after-tax operating income is what the business retains. And this is something that actually is used in the calculation of free cash flow, which we'll share with you in about 2-3 slides down. The balance sheet actually is a statement of financial position, which shows what are your assets and what are your liabilities and stockholders' equity. So this is it's kind of like a formula for assets equal to liabilities plus the stockholders' equity. So here is an example of a high-level typical balance sheet where you show the assets. For example, the under assets, as we said. You have cash, you have marketable securities, accounts receivable, inventories, prepaid expenses. I mean, so the total current asset is $6 billion. And then you have other assets like a fixed asset, plant, property, and equipment. You subtract the depreciation from there, and then your net plant, property, and equipment. This is like a standard balance sheet term. So that has like a 12,000 million, which is like a 1.2 million. Other asset is about 2, so the total asset is about 22 billion. And then the liabilities, you have the current liabilities, accounts payable, short-term borrowing, income tax payable, other accrued current liabilities. So the total liabilities is 12,000 million, like a 1.2 billion. And then the stockholders' equity is about 8 billion, so they're about $20 billion. So the reason why it is called balance sheet is that you have the total asset is equals to liabilities and stockholder equity, which is also 2 billion. So so this is actually a typical balance sheet statement. And the next one is the cash flow statement, which is kind of like a bank account active. It shows the cash flow in and out of the without the payables and receivables. And cash flow is very important because the company pays its current obligations through the cash, the purchase of raw materials, the salaries of employees, the taxes that it owes to the government, and the dividends that it owes to the shareholders. It all comes through from the cash flow statement. And earnings is one element of the cash flow, but also it includes the depreciation, which is a non-cash charge. So for example, here is an example of the simple cash flow statement. You start with the after-tax operating income, and then you add the depreciation, And from that you subtract the net working capital of 10 million. So because it's money that is tied up, so it's not free. So cash flow from operation is 97 million. So you add the ATOI, the depreciation, subtract the net working capital, you have cash flow from operations. And you use this money to fund your capital expenditure, so that needs to be subtracted. So that is the free cash flow that you have. So that is so those are the three statements: the income statement, balance sheet, and the cash flow statement. Those are the three statements that supply chain managers, it is recommended that you become somewhat familiar with how to read, understand, and interpret that. So here is an example of the parameter that the Wall Street analysts look at, the return on asset, for example. And the return on asset, as you can see, is a margin times asset turns, and we sort of expanded the value driver tree. So the value is how you calculate the margin times asset turns. So here is the margin, which the formula is profit over sales, and asset turnover is sales over assets. So if we follow this branch of the tree where the profit over sales, the net profit divided by sales, the net profit is the gross margin minus the total cost, and then the gross margin is the sales minus the COGS, and the variable cost, total cost, is the combination of variable cost and fixed cost. So that is part of the income statement. And on the balance sheet side, we have the asset turnover, sales over assets, and then we have the assets, current assets, and the fixed asset. Under fixed asset, we have plant, property, and equipment. And under current asset, we have inventory, we have accounts receivable, we have other current assets. So this column, actually, you can say that these are all the value drivers. You need to increase the sales, you need to reduce COGS, you need to reduce the variable cost, you need to lower the inventory. I mean, so these are all value drivers that contributes to the improved return on asset. So it kind of shows you the relationship between the different components of income statement and balance sheet. So another example of return on equity, where you have the income statement and the balance sheet, that's also, so you can create a similar value driver tree and sort of see the what can you do in the supply chain to really impact the return on equity. So this is just an example. We did not quite develop the tree because of because I mean you can use the example, you can do it yourself. So now we are gonna, so we talked about the financial terms. We established the fact that the supply chain glitches impact the stock price performance. We established the fact that the supply chain performance impacts the supply chain financial performance. So now we sort of identify what are the SCM drivers to to various financial parameters. So one of the things that we want to say is that the APIX score model actually does have include the cost and the asset into their performance attributes. So the supply chain cost and the supply chain asset management is part of the score model, which we as a supply chain manager probably don't pay much attention to. But the supply chain cost actually does include the COGS, which is part of the income statement. And also the asset, actually, it does include the inventory days supply, the days sales outstanding, days payable outstanding, capacity utilization, permanent investment turnover. So these are all actually, the score actually has already included in its model, but we hardly pay attention to it. So I just wanted to mention that and draw your attention to this aspect of the score model, which we should probably pay attention to. Now, so we'll now cover some of the financial metric and then also the SCM activity that impacts those metrics. So for example, revenue growth. The revenue growth actually is a financial metric that is impacted by good fill rate, improved customer service, a new product that you introduce from time to time, improved sales and marketing activity, Improved forecast accuracy will improve your fill rate, and the responsiveness, like the shorter lead time, the good product availability. These are all activities that sort of contributes to improved revenue growth. The operating margin is dependent on it is the revenue minus the total operating expense, which is the COGS plus the SG&A. And so it is divided, so it is the revenue minus total operating expense divided by the total revenue. So it is dependent on the reduced COGS and reduced the SG&A. And so this is something that as supply chain managers, we need to focus on our improved procurement, manufacturing, warehousing, and the distribution activities that will have some impact on the improvement in the operating margin. So, so here are the list of SCM activity that has impact on the improvement in the COGS and operating margin. So procurement, for example, the transportation management, supply chain response time, inventory management, the outsourcing. So for example, improved negotiated price for the purchased goods and services does impact COGS. Administrative expense, it does impact COGS. The inbound, outbound logistics cost does have an impact on the COGS and the operating margin. And then the carrying cost of inventory, the pilferage, damage, these are all insurance and taxes. These are all costs that does have some impact on the operating margin. So these are all things that we need to manage well to have an impact on the COGS and the operating margin. Another financial metric is the cash operating cycle, which is one of the components that if you remember, the SCORE model actually does use, and also it is an element of the balance sheet. So the cash operating cycle, the formula for this is the days in inventory plus the days sales outstanding minus days payable outstanding. And the way it is defined is that the number of net days from the time a dollar is invested in inventory to the time it is converted back to cash, hopefully with a profit. So, so this is something that a well-run business should have shorter cash operating cycle. So now we have three things: the days in inventory, days sales outstanding, and days payable outstanding. So what are these SCM activities that impacts the inventory? So there are a lot of things that has an impact on inventory. So for example, order frequency. The more frequently you order, the less you have to order. So that has an impact on inventory. A special purchase, if you want to take advantage of that, that will increase your inventory. Supplier discount generally entices you to buy more in bulk to take the advantage of the discount. So that increases your inventory. So you have to sort of like have a trade-off analysis to see whether it is worth the discount to have the higher inventory. So these are all things that the procurement is have an impact on the inventory. The transportation management, the mode of transportation. So for example, if you're shipping by rail car or ocean tanker, you'll be shipping in bulk, and it will increase your inventory. So the mode of transportation does affect inventory. Warehousing does affect inventory in terms of the visibility and design. The forecasting, if you have poor forecast accuracy, that will result in higher inventory because of the higher safety stock, because you have to maintain and manage the customer service. Supply demand balancing. So the good supply chain planning model can help you lower your inventory, and we have seen that in many implementations where a better planning did improve the inventory level. In the network design, a consolidated network requires less inventory. So good network design decisions should impact inventory, which will have an impact on the revenue and operating expense. And the supply chain response time, like if you have higher response time, then you have more, then you need more. The shorter response time have less inventory, longer response time, will have more, you have to carry more inventory. So these are all supply chain activities that we need to pay attention to manage the inventory. In days sales outstanding, the supply chain activity that has an impact on is the customer service, the order fulfillment, the sales and marketing organization, and the finance and accounting. Those are the organizations that are actually responsible for the days sales outstanding. Order fulfillment, for example, if you make partial shipment, for example, then the collection from your customer will be delayed because of the partial order fulfillment. So that's an example of how order fulfillment activity impacts the days sales outstanding. Similarly, for the days payable outstanding, the organizations or the supply chain groups that are responsible for the procurement, manufacturing, and finance and accounting. Then the financial metric, the fixed asset utilization. So we have manufacturing facilities, warehouses, corporate offices. One of the fixed asset that we did not list here is the for the logistics companies, the distribution assets, the trucks and the fleet, the rail car fleet. Those are also part of the fixed asset. And the formula for calculating fixed asset utilization is the revenue per unit of the plant, property, and equipment, which is the amount of revenue generated per unit of currency invested in plant, property, and equipment. So the transportation management is a supply chain activity which, like if a company operates its own fleet, then improved planning, load management, routing, dispatching impacts the fleet size and the fixed asset utilization. The network design also, a good network design also can help you consolidate the supply chain network. It may increase, allow you to rationalize your fixed asset like the plant and the warehouses, and so there is a trade-off. So the network design model can allow you to find a trade-off between the fixed and variable cost. Now, outsourcing is a different ball game altogether, which is so outsourcing actually changes the structure of operating costs. So when you outsource, you do away with your fixed cost, but it will increase your fixed cost. So you have to run an analysis to see if that is really beneficial, because outsourcing does not necessarily improve the overall financial performance. It just shifts the cost from fixed to variable. So you have to sort of make your own, do your own analysis to figure out whether or not it's beneficial. So we have looked into multiple financial parameters like the operating margin, the COGS, the revenue, the inventory, the cash to cash operating cycle, and what are the different supply fixed the fixed asset utilization, and what are the supply chain activities that sort of impacts those financial parameters. So now actually we are going to go into a case study. So it's a chemical company that has that operates in the basic chemicals segment. And so what we did we did a high level benchmarkings, for example. So the basic chemicals industry at a high level, the industry level gross margin is about 35-36%. The operating margin is about 10 to 11%, and the net profit margin is about 9%. Whereas the mid-chem has the gross margin is about 22% and the operating margin is 3% and the net profit margin is loss. So obviously it looks like, if you now, having understood the different income statement and balance sheet, now you know that they have a higher cost in their income statement, in the operating, higher operating cost and other additional costs that is actually eating into their margin. So that is something that we need to look at. And the management effectiveness, the return on asset and return on equity, as we have discussed, the Wall Street analysts kind of look at these parameters, and so they are in all these. So they are basically, I mean, if you look at the industry benchmarking, they are kind of like a behind the curve. The return on asset is about half the industry average, and their return on equity is quite low, about 2 to 3%. So what we did was we did some analysis of the business. So for example, we did some product line rationalization. We found that they have about 500 products in their product portfolio that has like a less than 5,000 pounds of demand. So we recommended the elimination and or substitution of the low volume, low margin products. We sort of recommended that they establish some kind of a differentiated customer service policy by using some ABC customer segmentation, because they have like about 700 customers who are buying less than truckload. And when we analyzed their income statement, we did find that their distribution expense is kind of on the high side. So this could be something that is contributing to their increase in the distribution expense. So we recommended that they establish some kind of mutually acceptable order lead times for better production and inventory management. We recommended that they set up some kind of an inventory policy for reorder quantity, safety stock location, establish customer service levels and the lead time based on ABC analysis. We did some analysis of their forecast sales order history, and we found that they have like a they have about 5 very high volume, high demand variability customers. So we recommended that they establish some kind of a collaborative planning relationship with them, like some kind of an external partnership, external integration with the customer to reduce the demand variability and inventory, and use the vendor managed inventory if possible. We recommended that they do some kind of a network design study to do the asset rationalization to improve their fixed asset productivity. So develop some kind of a decision support tool to improve fixed asset utilization by evaluating alternate sourcing and or planned closings. To improve their working capital efficiency, we recommended that they do some raw materials and finished goods inventory management. They reduce their receivable days if possible and increase the payable days if possible, and also develop some kind of a margin optimization model. So that was our recommendation. So then we looked into their income statement and balance sheet, and so here is what we found is the COGS is 80% of sales. So what we recommended is that they look at like if they can reduce the COGS by, let's say, a very conservative 2%, then they can gain in the inventory. The gain in dollars is about $10 million. Distribution expense was like a 5% of sales. So if they can reduce it by 0.5%, then they can gain $5 million. To improve the cash to cash cycle time, what we found is that in the balance sheet that they have like a 52 days of days sales outstanding. So we recommended that they explore the possibility of reducing it by 5 days. Days in inventory was 33 days. So we recommended that they explore it to reduce it by 5 days. And the days payable outstanding is 44 days. So we recommended that if they can increase it by 5 days, then the cash to cash operating cycle time can go down to 26 days from 40 days. So that will improve their cash flow. And the fixed asset utilization, if the 2 percentage point improvement will generate a $10 million gain. And so the total potential gain is $25 million. And so that is the analysis that we came up with once we analyzed their income statement and the balance sheet. So that is the end of the case study, and so here is the summary. So better supply chain. So in conclusion, we can say that the better supply chain management can create a competitive advantage through revenue growth, profitability, and capital utilization. So just consider a company with $100 million in revenue, just as an example, and let's suppose that this company is in the median compared to other companies in its industry. With just 1% improvement in total operating expense and days in inventory, the company would be expected to increase its long-term after-tax cash flow by about 8.5%. The companies that have not reviewed their distribution network in the last 5 years, they will typically see a reduction in logistics costs by about 10 to 20% while improving the service to customer. And the case study that we just presented is just one of the examples of how improving supply chain management activities can impact a company's overall financial performance. So that is all I have to share with you, and hopefully you have benefited from this presentation. So thanks for your interest and time.
Awesome. Thank you so much, Tepan, for walking us through today's presentation. So we would like to open up the pipelines for everyone else to begin to ask questions. And yes, at the end of the webinar, we will be sending out a recording of today's discussion, as well as of today's discussion in the coming weeks ahead. We would also respond to your questions privately if we are not able to touch on them today. So just to quickly jump into the questions for today from our audience. A question from our audience is saying, is cash-to-cash cycle time the most important metric for the recuperation? I'll just repeat the question just to make sure I got it. Is cash-to-cash cycle time the most important metric for the recuperation?
It is one of the most important ones because it gives you a measure of like how quickly are you converting your dollar that you're investing into inventory, how quickly you're getting your money back. So it is one of the most important, I mean, if not the most important.
Got it. I also know that you give a summary on why doing financial planning is very important. For instance, better supply chain management can create a competitive advantage. But how do you incorporate finance objective in your planning models?
So, so one of the things that you can really measure, for example, is that are you improving your return on asset, for example? That is something that is our planning model. We can sort of frame the model to incorporate the financial structures in the decision support tool, where the return on asset can definitely be incorporated in the supply demand balancing model, for example. Another key contributor would be like the inventory management. Definitely can be like based on your operating level, based on your demand supply, how should you manage your inventory? So that is one of the things that you can incorporate in your model. So instead of just lowering cost, you can also sort of like create the revenue and the expense. You can include in your demand supply balancing model to sort of get a sense of like how well you are doing in your, let's say, net margin contribution or gross margin contribution. These are all things that you can incorporate in your supply demand balancing model. Hope I answered your question.
Yes, you did. Yes, you did. And also, how do you sustain the benefits once you have gone through your supply chain transformation process?
So that is actually a really good question. I mean, you really need to sort of keep on the continuous improvement journey, which we sort of presented like a couple of presentations back, maybe a month or a couple of months ago. The supply chain transformation. So once you go, so that is actually the example that the study that I shared with you, where the leaders kind of like stay as leaders because they have done the transformation and they stay on the continuous improvement path. So you keep an eye on your financial metric to see if the revenue is increasing, if your costs are going down, if your SG&A So that's where I think you need to pay attention to your cash flow statement and also the income statement, where you keep an eye on your cost and see and keep an eye on your, for example, forecast accuracy, the inventory management, the different supply chain activities that you are engaged in. I mean, these are all things that you sort of need to pay an attention to so that you can stay on track with your continuous improvement journey, so that you stay as a leader.
Got it. So I know also that having a target for your business by which to work with is very important. But how do you define your financial objectives to achieve those targets?
So the targets actually generally, the two sources from where the targets come. Actually, for example, the Wall Street has some expectation that you, so the different analysts actually sort of like make a projection that this company will grow the revenue by 5%, for example. So once you have that thing established, then from there you derive the supply chain activities that you need to engage in to achieve those goals. In our case study, we sort of like, for example, showed you an example on like the COGS is 80% of sales. So we sort of had a target of, let's say, reducing it by 2%. So what are the supply chain activities? So when you look into our presentation, you will see, identify the supply chain activities that contributes towards COGS. And then you sort of like develop a supply chain transformation program to address the, that will address the reduction of COGS. I mean, that's how you sort of like do these things. I mean, it's really like a hard work. I mean, you really have to some understanding, and you have to really lay out some work plan to really accomplish those.
Got it. Also, how do you create a financial culture in supply chain managers, supply chain people?
So you have to really be familiar with the financial terms, financial statements. Make sure you understand like how you interpret the I mean, we have laid out some basic understanding of like how the supply chain links to different financial parameters. You need to develop deeper understanding of those, and then you can sort of need to learn how to speak the language of finance, and that's how you sort of develop the supply chain finance understanding, supply chain finance connection, understanding of supply chain finance connection.
Awesome. So this brings us to the end of today's discussion, but we'd also like to urge those who would like to see a demonstration of our solution. Please go on our website, akiva.com/demo, to place a request for a demo. We really wish you all the best and have yourself a great week. Thank you so much for joining us.
Thank you.
Thank you so much, Stefan, as well. Bye-bye.
Bye-bye.